This is the High Voltage Business Builders Podcast, daily intelligence for serious e-commerce portfolio builders across Amazon, TikTok Shop, Shopify, Walmart, and every channel that moves the needle. Neil Twa and his team, all day, every day since 2012. Let's get into it.
Imagine this. You're an Amazon seller, meticulously tracking your cash flow. Your product sells, Amazon processes the payment, and you expect that disbursement to hit your bank account. But now, effective August 1st, 2026, Amazon is flipping the script on how they collect advertising costs. No more separate invoices for your ad spend. Instead, they'll be auto-deducting those ad costs directly from your seller disbursements. This isn't just an accounting tweak, it's a fundamental shift in cash flow for every single seller on the platform. If you're a newer seller spending $500 a month on ads, that's $500 less hitting your bank account from a single disbursement cycle. For a growing brand investing $5,000 monthly, that's a significant chunk of working capital tied up differently. And for advanced operators dropping $50,000 a month on ads, this isn't just a line item, it's a strategic recalculation of your entire financial pipeline. This change impacts your available cash, your payment timing, and potentially your relationship with your business credit. How will this seemingly small operational adjustment force you to rethink your entire financial strategy on Amazon?
This new billing change from Amazon, effective August 2026, means your advertising costs will now be automatically subtracted from your seller disbursements. For the seller doing $5K to $50K a month in revenue, this is a direct hit to your cash flow timing. Previously, you might have received your full disbursement and then paid an ad invoice separately, often with a credit card to float the expense for 30 days and earn rewards. Now, that payment is essentially immediate and non-negotiable. If you spend $2,000 a month on ads, that's $2,000 that never even touches your bank account from Amazon. This isn't just about losing credit card points, it's about the timing of capital. Your working capital effectively shrinks, as money you might have used for inventory reorders or other operational expenses is now immediately consumed by advertising. For operators scaling past $100K a month, this necessitates a complete reevaluation of your treasury management. Are your cash reserves sufficient to handle these immediate deductions without impacting inventory turns or payroll? The underlying mechanic is simple. Amazon is securing its own credit risk and pushing the working capital burden directly onto sellers.
Let's look at how this change hits sellers in the trenches. Sarah, who runs a $30K month kitchenware brand, initially felt the squeeze. She was spending about $3,000 a month on ads, historically paying with a business credit card to leverage the 45-day float. When the auto deduction started, her expected disbursement was suddenly $3,000 lighter. She realized her inventory reorder for her best-selling garlic press was now delayed by a week because that cash wasn't available. Her adaptation? She immediately shifted her ad spend strategy to focus heavily on ACoS optimization, cutting underperforming campaigns aggressively and reallocating to her highest converting keywords. This forced her to be a much sharper advertiser, improving her overall profitability. On the other end, Mark, an operator managing a portfolio of brands grossing $500K a month, saw this as an opportunity. His ad spend was closer to $50,000 monthly. He understood the cash flow implication instantly. Instead of lamenting lost credit card points, he used the transparency of direct deduction to build a more accurate daily cash flow projection. He also negotiated better payment terms with his suppliers, leveraging his increased certainty about his net Amazon income. He even started using the freed-up mental bandwidth from not managing separate ad invoices to explore off-Amazon ad channels, diversifying his traffic sources. This is what sellers who survive platform changes do differently. To navigate Amazon's new auto-deduction for ad costs, sellers at every level need to implement 3 key actions. First, reevaluate your cash flow projections with precision. For a new seller spending $500 a month on ads, this means reducing your expected disbursement by that exact amount. You need to adjust your inventory reorder points and personal draw expectations accordingly. For a growing brand spending $5,000 a month, this requires a more sophisticated spreadsheet, accounting for varying disbursement sizes and ensuring you maintain sufficient working capital to avoid stockouts. Second, optimize your ad spend for absolute efficiency. If you're a smaller seller, scrutinize every keyword and bid. Can you cut $50 to $100 of wasted spend each month? Every dollar saved is a dollar that does hit your bank account. For larger operators spending $50,000 a month, this requires a more sophisticated analytics, A/B testing ad copy, and potentially investing in AI-driven bid management to ensure every cent delivers maximum ROI. The cost of inefficient ads is now an immediate cash drain. Finally, diversify your working capital sources. For a beginner, this might mean having an emergency fund or a small business line of credit ready for unexpected shortfalls.
For an advanced operator, it's about establishing stronger banking relationships, exploring invoice factoring for non-Amazon revenue, or even strategically utilizing short-term loans to bridge any gaps without disrupting your core operations. Don't rely solely on Amazon disbursements as your only source of available cash.
This shift in Amazon's ad billing effective August 1st, 2026 isn't just a minor update. It's a critical operational change that demands your attention. Whether you're just starting out, building your first brand, or scaling a multi-million-dollar portfolio, understanding and adapting to these platform changes is not negotiable for sustainable growth. At Voltage, we've been navigating the complexities of e-commerce for 13 years, helping sellers like you build profitable, resilient businesses. Our expertise isn't just theoretical, it's forged in the daily realities of operating on Amazon. We understand that every dollar counts, especially when it comes to cash flow and ad spend. If you're looking for deeper insights, strategies tailored to your specific business stage, and the tools to thrive amidst constant platform evolution, visit us at Voltage. Our resources are built for operators by operators. Don't just react to Amazon's changes, proactively build a business that leverages them. This is the High Voltage Business Builders Podcast. Your business, your rules.
That's a wrap on today's episode. If something we covered today sparked an idea or made you wonder where you actually fit in the e-commerce landscape, there's a good place to start. Head over to voltagedm.com/discover. Answer a few questions, and we'll point you toward the right path for where you are right now. We'll be back tomorrow with another edge. Until then, stay high voltage.